Hey, welcome back, traders. It's John. This is a GMU update. It's May 9th. This is Thursday night. I'm recording this on Thursday night because on Friday I'll be going out to Syracuse. It's my son's graduation from college. He's graduating with a chemistry degree, and then he's going to move on to grad school at NC State. So it's going to be a big Syracuse weekend. So hence the reason for the GMU being done tonight. So again, reminder, all these GMU extras are for educational purposes only. So the agenda is straightforward. We're going to get into the indices. There's been a lot of change this week, and we'll look at the breadth that's supporting the change. And then we're really going to spend more time on our watch list, and I'm going to go through, 4 or 5 different charts of interest. And then we'll wrap it up. So delving into the indices and breadth. I showed this chart on April 5th, GMU, and I'm showing it again because I had a question come in about follow-through days. Last Friday we were looking at, there was a lot of debate if last Friday was a follow-through day or not. And I show this chart because the way that I look at things, pullbacks of 3 to 5%, I really don't need a follow-through day for the trend to resume. It's only when you get at least 8%, really 8 to 12%, which I call an intermediate correction, that I really require a follow-through day to really reset the uptrend. And so, as we'll look in a moment, the NASDAQ corrected about 7.8, 7.9%. It's really between the two, between pullback and correction. My interpretation is we really didn't get into the intermediate correction zone. So I wasn't looking for a follow-through day. I'm looking at stocks, looking for other measures to see if I want to put my toe in the water. And I've mentioned a few times in these videos in the last 2 weeks about taking some pilot positions. So I wanted to just refresh how I approach it. This is how I look at it. So here is a current chart after the close today of the NASDAQ composite. Still razzing Jim Ropel. He was really, really bulling up on the market here. So we're just putting that as a flag on the chart. We're just giving Jim a little bit of a razz here. He's great. Love his enthusiasm. But here's the chart. Like I said, we've not quite gotten to an 8% with a decline that we had. Really don't need a follow-through day if this were to continue the uptrend in my mind. But I wanted to show that the NASDAQ percentage of stocks above the 50-day moving average has really improved steadily over the last few weeks. We're up to 52%, and we haven't been that high since we started the decline. So we've had this move that's been a little bit choppy. Last week, we had the push above the 50-day, which was good. And we've had some continuation on Monday, Tuesday, but then things kind of went sideways a little bit on the last couple days. So the good news is we've gotten above the 20-day moving average for 5 days. So that's good. That's really signaling maybe there could be a change of trend. I will admit, though, the volume is not great. It's a little suspect, but volume is a secondary indicator to price. So we follow the price first. And in conjunction with looking at individual names, and we're going to look at a few, some of the individual names are really starting to act much better, and they're coming up the right side of basis, and some of them are actually breaking out. Remember, throughout this period of time, from probably mid-February all the way through early April, we were kind of in a stealth growth stock correction. Even though the indexes were kind of holding up, there was a lot of distribution masking the stocks that were breaking down below the surface. So names are getting better. We are reaching an area here where I think it's natural that we might get a little bit of a pause and get a little bit of a digestion of this move up the right side. You see, we've run right up into where some of those new highs that we tested way back in late March, early April. So it wouldn't be surprising at all to kind of pause a little bit to gather itself and then move higher. That's what it looks like right now. But who knows? Maybe tomorrow we gap up and just start running, or who knows, we could gap down and things fall apart. Just got to stay flexible. So the other piece of the internals that is looking much better is We've got 6 days in a row, net new highs on the NASDAQ that are above 50. So that's really good. Finally, we're starting to see some continuity of the new highs coming back into the NASDAQ, and they're actually a little stronger on the S&P. So a lot of improvement this week. We're kind of at a juncture where we'll see what happens tomorrow. And then we'll see if we can eventually push higher into new territory. Some of the internals seem to be supporting we're going to move higher. Okay, so this is the S&P as of the close. So you had this little shakeout, as we had declined down, we shook out kind of underneath the 5,000 level in the S&P. Then we've been trying to make our way back up the right side here, and we've clearly gotten some support off the 5,000 level as we tried to do that. Again, we're back above the 20-day and the 50-day, even in the S&P. So that's good news. And again, the volume looks a little suspect, but again, I don't want to place too much volume emphasis. Price is telling us that's our number one indicator. But you can see new highs is also improving on the New York Stock Exchange. We've had 4 days above 50, and they're starting to pick up. So that's all constructive internally. Things are strengthening versus where they were, a month ago when things were really, really weakening. So it looks like we might possibly get a little rally here. Another piece of evidence on the breadth, this is actually the New York advanced decline line. We haven't looked at this in quite a while, but you can see here that this is I believe I have a weekly chart here of the advanced decline line. And you can see that the advanced decline line is actually pushing to new highs. It's actually in new high ground, and yet the S&P is still slightly below its old peak. That's really bullish. It means the breadth of the market underneath is still showing us that the broader market is strengthening even more than the index. So the advanced decline line has been pretty strong most of the year, and we've had this little pullback. Hopefully it was just a healthy pullback, and we're going to keep moving to new highs. Now I pulled up this chart to look at group leadership, and I did this specifically because I wanted to, we all focus on growth stocks, and we want to see growth groups, leading the way. But we also don't want to be biased to other groups that are performing. And so when you really just say objectively, what's outperforming the NASDAQ since we've had the lows of the NASDAQ correction, which I've shown here in this big oval, this is the point where the market bottomed. And you can see this black line is the NASDAQ composite. And just objective, which groups are actually starting to outperform? So here's one, aerospace and defense. And I've pulled up a couple symbols. You might want to look at them. They're pretty strong charts. Now, interestingly enough, with aerospace doing well, the airlines are doing well, defense stocks are doing well, and steel specialty alloys are doing very well. It's actually one of the higher outperformers in the NASDAQ since we bottomed. CRS, ATI, USAP, these are all specialty metal alloy companies that make a lot of the components and parts for aerospace and defense. They're really doing very strong price action. Gold and silver mining stocks have really picked up. They're currently outperforming the NASDAQ. So there's some names there to look at. Surprisingly, you wouldn't look at this group normally, but AC and heating is also outperforming with a lot of the infrastructure from the infrastructure bills that have been passed by the Biden administration, the reshoring of some of the plants coming back to the U.S. There's a lot of big construction going on and a lot of needs for heating and cooling in addition to data centers. So that group is performing well as well. Now, restaurants have been strong too. And there's a number of names. You're all probably familiar with these names. Chipotle, Cava has been a hot IPO, Shack, Wingstop, Texas Roadhouse. So the restaurants are performing. So, we don't want to be biased and only look at growth stock, techie type groups. Sometimes you can find leadership in the groups that are, quote, leading. Now, we all kind of immediately instinctively say, well, semiconductors has to lead the market, and software has to lead the market, and cybersecurity, and these tech names, tech groups. Well, currently, semiconductors is currently lagging the NASDAQ. I put it on the chart, not by much. It's trying to push a little higher. SMH is trying to rebound here, and it may rebound, and maybe semiconductors take a leadership role again. But at the moment, the leadership is coming outside of pure tech at the moment. So try not to be biased and keep your watch list flexible. So let's get into the watch list and let's look at some charts. So I've just got 4 lines here. I did not group them in any specific nature because I've expanded the list of names that I'm looking at, and I'm also taking some names off the previous 2 weeks list of stocks that have broken down or are weaker. So this is just a good list of names I think that have things to monitor. There's stocks that have broken out. There's stocks that have exhibited good shakeout action and are starting to move higher. Some of them are still in pure basis, so they still haven't broken out yet. So I think it's a good list to keep your eye on in terms of leadership in the market. All of the names in blue, Wingstop, Nutanix, CLS, QCOM, NVIDIA, Crowd, and Chipotle, those are flags. I want to let everybody know that I do have a position in all of those symbols right now. So let's look at a few of these charts in more detail. So this is Comfort Systems from that air conditioning and heating group, which has really been strong over the past year. Like I mentioned, there's a lot of infrastructure being built and a lot of needs for heating and air conditioning, and these companies are seeing some real growth. So I mentioned just a while ago, I do have a position, a starter position in Comfort Systems, and I'll show you how I got into it. But the chart is, it's had a nice strong uptrend, and as the market's been correcting the last, 8 weeks, you can see that this stock basically went sideways. You can look at it as a double bottom that had a really nice little shakeout below the 50, almost got down to this blue line, which was the 65-day. But what I liked about it was the little V that came down sharply, shook people out, and then it recovered very sharply. And then it actually came back and got some support here at the red line, the 50-day moving average. And then the stock really started to power higher late last week. We had a gap up, another gap up. We blasted out of the double bottom formation, and we had some good subsequent follow-through action the last 3 days. So I took a position. I've actually ticked it right here. I bought in here. I have a position. Also, I really like the fact that the relative strength line is almost vertical, showing, and it's at new highs, which is shown by this dot. So that being at new highs, it's confirming the breakout. The stock did digest a lot of gains. So hopefully this is something that has some potential to make a move at least 20-25%. So that's a good stock right at the moment. It seems to be leading. So Sweet Green is another one that I'm keeping my eye on. Last week I mentioned that sometimes you can have a failed shakeout where the shakeout looks like to be a shakeout, but then it rolls back. And I mentioned last week that you should keep these on your watch list because sometimes shakeouts can morph into double bottoms. So in analyzing Sweet Green, way back over here, they had a really good earnings report, and that got the stock going. Had a big earnings gap up, and you can see the follow through day. Had a very powerful move, really obeying the 10-day moving average, which is that bluish line. Then the stock started to come in, and the stock came in, and 2 or 3 weeks ago we were looking at this saying, well, maybe this is going to be a shakeout at the 50-day moving average, and it looked like it was going to be a shakeout, but then it kind of rolled back hard and looked like it was a failed shakeout. And as I mentioned, sometimes you have to be flexible as these things can morph into other patterns. So maybe what was happening was this is the first leg down into double bottom. We came up. You can see here's the real shakeout. We have a very sharp shakeout. We're actually right down and undercut the 65 EMA and a very quick recovery, and the volume picked up. And you can see here the last few days, the volume has picked up. Now it's been a little volatile here with earnings. They just had an earnings come out. So we'll have to see how it reacts after earnings. But, maybe this is really the shakeout of a double bottom pattern. Your standard pivot would be the middle point of the double bottom. But I think it's a name to keep an eye on. It seemed to have some momentum from this real earnings reaction here. We'll have to see how it digests tomorrow with its earnings report. Here's Qualcomm. I own a position in Qualcomm, and I wanted to just break down the chart. Again, this is a name that's been, it's a very large company right now, but they're really the king of the smartphones in terms of their chipsets, and really their growth is going to come as AI gets integrated into phones. They have such a stranglehold on the chipsets worldwide that if there's an upgrade in phones that need chipsets, it should help Qualcomm maybe see another period of growth. So again, as the market started correcting in March and April, the stock started moving sideways. And then as the market really sold off in mid-April, you can see that there was a shakeout created. We broke below the old lows. We came down below. We actually shook out below the 65-day. And you can see the volume picked up. But then we got a nice recovery, a very sharp V, which we like to see. And so it recovered. And then we had earnings. The stock on earnings had a gap up. The report was a little better than expected. They gave some pretty decent guidance. And so we got this nice earnings gap up with a high volume close. You can see the huge volume, some of the biggest volume it's had in a long, long time. So that's meaningful. And you had the high volume close and, using some techniques about how to buy earnings gap ups and high volume closes, which I get into at Rain King Insights. I bought the stock a couple days ago using this high volume close and some moving average and techniques. So I think this stock has a little bit of potential to make a move of 20-25%. We'll have to see how it goes. Here's United Rentals. Again, another one that's not associated with being a growth stock per se. You'll notice over here I've put, this was actually a stock. It's a Rain King pick. This is a pick I made in December. It was on my list of, 15, 17 stocks that I picked. I picked it right here. It's moved up about 20%. That's pretty decent in the first 4 months of the year. So it's been a decent mover. You can see here again, after the move, it was kind of moving sideways and digesting, and then it was dragged down sharply with the market sell-off that happened in mid-April. Again, we're down, it undercuts the 65-day, and you can see very sharp V. I like the V action. You can see the V with some power off that. When you look at the volume picked up here, really leading us to believe that maybe it really was a shakeout and the undercut. So it did come back in, but it did grab the 65-day one more time. So it's kind of digesting and sandwiched a little bit between the 65-day and the red line, which is the 50-day. We'll have to see how this turns out. I do think it's an interesting pattern. It's been a decent enough length of pattern to shake out people and wear people out, that if it does tighten up over here, I think it could be taken at the old highs. But we'll have to see how it goes, but it's something I have on my watch list. So I wanted to also look at, I guess this would be a little bit of an educational lesson on bases. This is Pinterest. Now, Pinterest, I had a couple people ask me about Pinterest, had this big earnings gap. And the people said, what do you think of Pinterest? And when I initially looked at the weekly chart, and this is a weekly chart, when I quickly looked at it, I immediately said, oh, that's straight up from the bottom. That's an SUFB. And, most people didn't know what I was talking about. So I'm going to take the time here to explain all this. So what SUFB is something that if you look at some of Bill O'Neill's old charts, he used to write SUFB on the chart. And it basically represents a flaw in a base. And it stands for straight up from the bottom. When you have a stock that's trying to make a base, and right off the lows of that base, it tries to go up into new highs, that's a flaw. And the reasons it's a flaw is because, first of all, the best bases are typically symmetrical. And these bases tend to be very lopsided. There's no handle in the base. We like bases that have some sort of small consolidation near the old highs. There's no handle. We also, the handle serves the purpose of shaking out the weak holders. We don't have that happening when we come straight off the bottom. So, Bill used to flag this and say, this is a much riskier situation because what happens typically is you'll come straight off the bottom, you'll go into new high ground, people chasing the stock will buy it here, and then the stock will immediately snap back and kind of correct and really build a handle, and you'll get stopped out. You can get really whipsawed. So they're riskier. So my initial reaction was this was straight up off the bottom. And to illustrate that, in my mind, because I've looked at so many charts over the decades, I said that reminds me of, Elastic in 2019 when Elastic was an IPO. So here's the Elastic chart, and it's another great example of straight up off the bottom. You can see here, starts to form a base, and rather than kind of being symmetrical, you get this sharp move, and it goes all the way up into new highs. And here's what can typically happen. If you chase the stock by new highs, look how it snapped back and basically put you under a lot of pressure, probably stopping you out or worse. Here's the IPO. It was a new issue back at the time. So this base fell apart and didn't work. And it just illustrates the point that straight up off the bottom is a flaw. Now, I'm going to go to the next slide, which is taking the same two stocks, but looking at the daily chart. So it's kind of ironic. I put these two charts side by side, and look how similar they are. Let's look at Pinterest first on the right. So Pinterest, the way it started its base here, it had a gap down related to earnings, and the stock kind of kept grinding its way lower. It had this little 1-2 day rally attempt into the 50-day, immediately was rejected, and then basically you had the situation where it undercuts once, undercuts again, and shakes people out. And then eventually you have this, strong move. This was actually a catalyst of a really positive earnings report. So there's a gap. You have a nice gap, and then it kept going and following up, straight up off the bottom. It's at testing new highs right now. But if you look back at Elastic, very eerily similar. This base structure started as a gap down. You can see the gap down. About midway through the base, Elastic tried to pop its head up above the 50-day, had that little 1-day rally, very similar, and it actually poked down. And then you can see here's the lows of the base, and it has multiple shakeouts. Undercut here, shakes people out, then another undercut, shaking out again, very similar to what we're seeing in Pinterest. And then again, here's the rally, straight up off the bottom. It really doesn't pause at all, and it gets into new highs and completely rolls over, and you get stopped out. So you might say, how could a chart be so similar? Patterns of charts are really reflecting human psychology, and the psychology in the base is very, very similar. There's trapped buyers in the gap down. There's people who get shaken out under these undercuts. So it's really it's interesting to see a chart so similar, and these charts are 5 years apart. So a little bit of time there to talk about straight up off the bottom. It is a flaw. Typically, you're going to want to not chase these stocks, and you're going to want to see it, let it try to make a little handle. If it can make a little handle and it's reasonable, it's only a 5 or 10% handle, then maybe that corrects for the straight up off the bottom, and you can buy it off the handle. But many times you get this kind of rollover, and it doesn't work out. So just a little bit of an educational piece on flawed bases. So just wanted to quickly emphasize again, Rain King Insights, the membership options. If you didn't watch last week's video, I spent 10 minutes going over some of the details of Rain King Insights, and I won't belabor it here, but I'm excited about getting this project launched. It's going to be delayed a little bit, but I'm going to try and get it to go. But if you're interested at all in any sort of early bird specials or discounts I have, please send me an email. I'm putting together an email list that I'll reach out to you when we get ready to launch. So submit that to support@rainkinginsights.com. So let's get back to wrapping up the summary for this week. So the week's not completely over. We got to see what happens tomorrow. But again, as of Thursday night, there's been some improvement in the market. And the S&P and NASDAQ are both within 1 to 2%, excuse me, 1 to 1.2% of their old highs. So we're almost at all-time highs. So we're within striking distance. The market is showing us some strength under the hood now, which is really, really encouraging. We've also reclaimed the 20-day for 3 days. I think it's 5 days on the NASDAQ. 3-day minimum is what I look for as kind of changing the trend. So that is a box that's checked off that, maybe this rally will get some legs and go. We talked about the internals. Net new highs are improving. They're building up. So that's really, again, that's improvement. Didn't look very good a week ago. And leading stocks. There are leading stocks for the next rally that are emerging. Go through the watch list I have. I'm sure you have your own names as well. And we broke down a few charts tonight that look interesting. So again, I believe that this was a week here to increase exposure levels. And really that's primarily based around pilot positions are getting traction. I know I've seen some traction in 3 or 4 positions, which allows me to increase my exposure. So I think exposure should be somewhere in the 25 to 40% range. We'll see what tomorrow brings. I think the Michigan sentiment data comes out tomorrow, but we'll see what the market gives us. But exposure, if positions are working, I think it's fair enough to put some more exposure out there. So that's a lot for this week. I hope everybody has a great weekend. I'm going to enjoy Syracuse. But the quote of the week this week is from Martin Zweig. Big money is made in the stock market by being on the right side of the major moves. I don't believe in swinging against the tide. So we want to be flexible. 1 to 2 weeks ago, things didn't look too good. We were cautious, but things have improved this week. And we're starting to see some emergence of leaders, though they may not all be in tech. So be flexible and try to stay on the right side of the major moves. That's it for the general market update for this week. It's Thursday, May 9th. We'll see you all next week.